sector versus industry. The differences are often confused between a sector and an industry. Both terms are used to categorize a group of companies that provide similar services. The difference comes from the scope of this categorization. A sector describes a large segment of the economy that groups companies based on a broad generalization. For example, the technology sector includes companies that produce electronics, software, and computers. An industry describes a much smaller segment of the economy and groups companies based on a narrow generalization. A sector is often broken down into smaller industry segments. For example, the computer industry includes only companies that produce computers, and the software industry includes only companies that produce software, but both industries are part of the technology sector. Business cycle. The business cycle is the natural fluctuation in economic growth that happens over a long period of time. The 5 stages of the business cycle are growth, peak, recession, trough, recovery. Growth is the period of expansion where economic growth is increasing, and a peak is the top of this growth cycle. Recession is a decline in economic growth. A trough is the bottom of this decline, and a recovery is where economic growth moves away from the low point. Sectors. The 11 sectors include financials, utilities, consumer discretionary, consumer staples, energy, healthcare, industrials, technology, telecom, materials, real estate. Financial sector. The financial sector consists of banks, investment funds, insurance companies, and real estate firms, among others. In general, the majority of the revenue generated by the sector comes from mortgages and loans that gain value as interest rates rise. Utilities sector. The utilities sector consists of electric, gas, and water companies, as well as integrated providers. In general, the sector generates consistent recurring income by charging consumers and businesses that provide higher than average dividend yields. Consumer discretionary sector. The consumer discretionary sector consists of retailers, media companies, consumer service providers, apparel companies, and consumer durables. In general, these companies benefit from an improving economy when consumer spending accelerates. Consumer staples sector. The consumer staples sector consists of food and beverage companies, as well as companies that create products consumers are unwilling to cut from their budget. In general, these companies are defensive plays capable of withstanding an economic downturn. Energy sector. The energy sector consists of oil and gas exploration and production companies, as well as integrated power firms, refineries, and other operations. In general, these companies generate revenue that's tied to the price of crude oil, natural gas, and other commodities. Healthcare sector. The healthcare sector consists of biotechnology companies, hospital management firms, medical device manufacturers, and many others. In general, the sector is considered to be both a growth opportunity and defensive play, since people will always require medical aid. Industrial sector. The industrial sector consists of aerospace, defense, machinery, construction, fabrication, and manufacturing companies. In general, the industry's growth is driven by demand for building construction and manufactured products like agricultural equipment. Technology sector. The technology sector consists of electronics manufacturers, software developers, and information technology firms. In general, these businesses are driven by upgrade cycles and the general health of the economy, although growth has been robust over the years. Telecom sector. The telecom sector consists of wireless providers, cable companies, internet service providers, and satellite companies, among others. In general, these companies generate recurring revenue from consumers, but some subsets of the industry are facing rapid change. Materials sector. The materials sector consists of mining, refining, chemical forestry, and related companies that are focused on discovering and developing raw materials. Since these companies are at the beginning of the supply chain, they're vulnerable to changes in the business cycle. Real estate sector. The real estate sector consists of companies invested in residential, industrial, and retail real estate. The main source of revenue for these companies comes from rent income and real estate capital appreciation. As a result, this sector is sensitive to interest rate changes.